As I mentioned in the prior slides, the company can acquire the property, plant, and equipment through non-monetary assets exchange. This transaction is an exchange of non-monetary assets. Basically, is the old assets exchange for a new asset. The fair value of old assets may be different from the fair value of new assets acquired. The difference will be cash payments or cash receipts. For example, if the fair value of old assets is greater than the fair value of new assets, the company will receive cash. Otherwise, when the old assets fair value is less than the fair value of new assets, the company need to make additional cash payments. And during these procedures, we will record the new assets fair value as a book value. And all the assets, since it is traded in, the title has been transferred to the buyer. So we are going to remove these assets from the book. At the same time, recognize gain and losses from sales of these assets. The gain and losses is determined by the fair value and book value of the assets given. So if the fair value of all the assets is greater than the book value of all the assets, this will result in a gain because the fair value is greater than book value. Otherwise, if the fair value is less than the book value, this will result in a loss. The procedures to document this transaction is step 1, we recognize the new assets at fair value. We will debit the fair value of new assets. Then remove the old assets book value through the journal entries. Record the cash receipts or payments. Record any gains and losses. Depends on the fair value and book value of old assets. You're given the book value of old assets 100,000, which is the difference between cost and accumulated depreciation 400,000. So the 100,000 is the difference between 500 and 400,000. That's a book value. And it has fair value 150. In this exchange, the company who acquire new assets by trading in these old assets pay cash 430,000. So that indicates the fair value of new assets is the fair value of old plus the cash payments. So total 580,000. So step 1, we are going to debit assets new 580. The second step, remove book value of old assets. The book value of old assets cost 500, accumulated depreciation 400. So we are going to debit accumulated depreciation 400,000 and credit assets 500,000. So the account of these assets will be 0 after this journal entry. And because the accumulated depreciation was credit 400,000, after debit $400,000, the balance will be 0. The old assets at cost was $500,000 debit. After this journal entry, 500,000 credit, it becomes 0. So for accounting, these accounts are 0. Basically, these assets are moved out of the book or removed from the book. And also we document the cash payments for 30. We also recognize gain and losses. Since the fair value of old is greater than the book value, so difference 50 will be the gain. So we credit gain. This is an equation to determine the gain. A similar example, the book value of old asset to be traded in 100. The fair value was 75. So in this case, 75 is less than the book value 100,000. So the difference 25,000 will be the loss to be recognized. We will talk about this later. And the fair value of a new asset will be 75, the fair value of old plus the cash payments. So it's 505,000. So we debit new assets and remove the old assets by debit accumulate depreciation 400, credit equipment old 500. And then we credit cash payments and debit loss 25. Why it is loss? Because fair value is less than book value. The difference is loss 25,000. In these two examples, we can have the fair value of new assets because based on this framework, the fair value of new assets equals the fair value of old assets and the adjustment to the cash payments or cash receipts. But sometimes we may not be able to get the fair value, or fair value is not determinable. So in this case, we only have the book value of old assets. We don't have the fair value of old assets. There's only cash payments. Different from prior example, we don't have the fair value of old assets. So the fair value of new assets is not determinable. In this case, we will use the book value of assets plus the cash payments. The book value of old assets, cash payments. So we document the new assets 530. And again, remove the old assets from book by debit 400,000 to the accumulated depreciation and the credit equipment 500,000. And then debit cash. No gain and losses to be recognized. The reason is we don't have the fair value of the old assets. So no gain and losses will be recognized. All the prior three examples are based on one assumption I didn't mention. These transactions all have commercial substance. All the exchange in the prior slides have commercial substance. The definition of commercial substance is this exchange can have impact on the firm's cash flow in the future, significant increase or decrease. If this exchange has no impact on the firm's future cash flow, we say this exchange lacks commercial substance. So what transaction or what exchange is considered to have commercial substance? For example, the newer model of equipment increase the production, improve manufacturing efficiency. So this will also increase the profitability of the company and finally increase the future cash flows. That's the consequence of the exchange. If the exchange has commercial substance, gain and losses are all recognized. If the exchange lacks commercial substance, the gains will be deferred. Since the exchange lacks commercial substance, it does not improve the company's profitability and future cash flows. So it loses the base for us to recognize gain for the company. So all the gain will be deferred. So the book value of new assets will depend on the book value of old assets plus cash payments. And it doesn't matter for loss situation. The book value of land 2.5 million, fair value 4.5 million. This exchange, the buyer pay $500,000 cash. The land is now subject to depreciation, so we do not have the accumulated depreciation account. The book value of old assets 2.5, fair value 4.5. If it has commercial substance, we should recognize $2 million gain for this exchange. However, it lacks commercial substance. So the new land's value is determined by the book value of old 2.5 plus cash payments. So we only recognize $3 million. Remove the book value of old land by credit land 2.5, credit cash. If this transaction has commercial substance, okay, just assume the new land value will be $5 million because that's $4.5 million plus $500,000. And we should also recognize gain $2 million in this transaction. But this example lacks commercial substance. The gain 2 million will be deferred. So here is a summary for the exchange of non-monetary assets. Follow each step. So the company should recognize that gain or losses. So gain and losses depends on the book value and the fair value of old assets. So the fair value of old assets, 75,000, subtract book value of old assets, 70,000. So difference 5,000 is the gain. Gain $5,000. What's the book value of new laser equipment? The book value of new laser equipment depends on the fair value of old plus cash payments. In this example, is 90,000. So fair value of old 75, 90. So the book value of new laser equipment is 165. And this is also the fair value of new laser equipment, which will be documented in the financial statements.